Hi there. Welcome to the Real Estate Expert Summit session again. This is Chuck Sutherland. Today we have Jonathan Bengel on the line, and Jonathan is a tax expert. And it's as someone has said, it's not what you make; it's what you keep after you pay the government what they have. So what they have, what they want, I should say. So Jonathan, welcome to the Real Estate Summit.
Thank you, Chuck, for having me here.
We're glad to have you here. Why don't you tell us a little about yourself and what it is that you focus on and why other people should be interested in that?
Yeah, absolutely. I mean, here we go. Are you ready? So for those of you that don't know me, my name is Jonathan Bengel. And by the way, Chuck, thank you for pronouncing my name so well. A lot of people mispronounce it. I've been nicknamed the Bagel, but I digress. I'm Jonathan Bengel. I'm a business profit tax coach extraordinaire, speaker, author, and entrepreneur. And today, women and LGBT realtors hire me as their elite business tax strategist to guide them through the darkness of taxation and business owners and transform their lives to financial happiness. For the past 18 years, I've created a multi-six-figure business, created my own talk show, Naked Tax Talk. And now, with more than 500 followers between Facebook and YouTube, that's where and I also now have, there you go. Sorry, I get confused sometimes. And I also wrote the #1 best Amazon seller in 5 different money categories, both nationally and internationally, called The ABCs of Deductions, an entrepreneur's guide to tax write-offs. And as a result, I was able to really utilize these tools to transform people's lives, really. I'm an IRS enrolled agent, a certified tax coach, and a certified tax planner. But Chuck, you wouldn't believe this. This has not always been my story. You know, I was born to a single mother and born to a single mother, and I was raised in what I call extreme poverty. And I define that by my mother only bringing in $500 a month to support herself, my younger brother, and myself. And as a result, my mother would move us every 3 months to a new place because she couldn't afford the rent, or the landlords decided to kick her out last minute because she just did not know what she did not know. And as a result, we often didn't know what we were eating. Our clothes were always hand-me-downs. And I was also not privy to a lot of the things that money brings to young people when they're growing up. You know, I was supposed to be a statistic. When you're born into poverty, you know, I was supposed to still be poor. I was supposed to still be uneducated. I was still supposed to be living with my mother or living on the streets. I'm supposed to have at least 4 to 5 children that I contributed to different baby mamas. I should not be the successful person that I am today. This is what poverty does. Systematic poverty does this. The chances of breaking through are less than 5% to actually break through the cycle of poverty. And you know what else we break through? Our telephones that ring. So mine's ringing. I don't know if you can hear it on the audio or not. But with that in mind,
Opportunity calling. Opportunity is
calling. That is opportunity calling. You know what? I'm going to let it ring.
Yeah, I would say, Jonathan, I do know several of your tax clients, and I know how happy they are with you because of what you have saved them in taxes over what they've been paying in previous years before they came to you.
Yes.
So that's what people should be interested in, particularly, is saving the money on taxes, not only this year, but next year and next year and next year and next year.
Well, that's perfect because you're absolutely right? So I do save my average clients on average that they're grossing $150,000 or less. Our average savings is over $40,000 in taxes. Once you get to about $250,000 to about the $500,000 mark, it jumps up there to $100,000. And then once you get into closer to the million, 1.5, 2 millions, now you're in the multi-six-figure savings. And this occurs year after year. So it's not like a one-time set it and forget it. it's literally reoccurring savings to the volume of thousands and thousands of dollars in tax savings. But every business owner, including my realtors, they all want to just like go straight for the mother lode and start investing and stuff, which is what we need to do. But they also forget some basics when it comes to these entities. And I'm known as somebody who believes in 4 fundamental areas of our businesses. I call it my seed method. And that is that we have to first start with the separation of self from our businesses. Do you know, Chuck, I have a lot of real estate experts that come into my field, a lot of real estate investors, be it passive or active, a lot of multifamily unit people, et cetera, that come into my world. And the one thing that they all lack at some point before they come to work with me is the first thing to a successful business in real estate. And that is the separation of self from their businesses. And so what I mean by that is that they commingle their funds between their different properties. They don't have any separation from themselves. They rob from their own cash flow as the money comes in. There's no set structure for how to actually pay themselves. It can become a nightmare. It's great money, but without proper planning, this is what happens. So I created my own success method, really, by understanding some of the basic fundamentals to business ownership from a tax perspective. And what it is that every business owner wants to be able to save money on their personal taxes. They want to be able to be free of the audit, or if they are, that have a very successful outcome. They all want to know what their tax bill is going to be at the end of the year. And ultimately, they fundamentally do not want to pay the government any money at all. And in fact, we can legally do this through proper planning. So the separation of self is so important. And here's why, Chuck. A lot of people don't understand this, but when the government comes a knocking, Uncle Sam is going to take the position first that all deposits coming into your checking account is income to your business. So we have to really, truly separate that out and say, these are really commissions, these are really rents, these are really loans, these are really other forms of, revenue, et cetera, because again, the position is first, everything is income. And so this is why one has to really invest in an accountant, a bookkeeper, et cetera, to maintain the separation of self from the government. Then the other thing is I'd like to share with everyone here some 3 legal tax strategies that they can implement right now to maximize their profits so that they keep more of their money and they pay less in taxes. Exactly what you talked about a little earlier in the show. So number 1 is that they need to consider their taxable entity. So I know that a lot of realtors have heard the rumors of every real estate company should have an LLC, or every real estate property should have an LLC. Somehow or another, some corporations should be formed, some partnerships should be formed, et cetera, et cetera. Now, here's the thing, right? An entity choice is created for the protection of the assets. We know this already. For some of us that don't know this, the entity is really important because if something goes south, they're only going to limit it to what the entity has inside of it. So what I find is that we need to create legal entities from a tax perspective. And when it comes to our tax lives, one thing we have to keep in mind when we're dealing with real estate is, yes, let's protect the assets, but then we should create other entities that manage the real estate itself. And this is where we get to play with these advanced deductions that I also will talk about in a little bit, but advanced deductions that we get to play with in other types of entities that are managing all of these other single homes that maybe someone's investing in heavily. Or for example, let's say it's you, Chuck, myself, and another dude named Henry, and we all decide that we're going to go and invest in a depressed area that the government calls a qualified opportunity fund. And we're going to invest all of our money and we're going to go buy some properties in them. Well, Chuck, the first thing I want to look at is, there's 4 of us? Are we all shareholders first? Or are we a combination of corporations and partnerships? And then are we further protecting it by creating single member LLCs that are the partners inside of the partnerships, which then are also the shareholders of the corporations that manage everything? So people who invest in real estate, if they do it correctly, there is one, a lot of opportunity, two, a lot of complexity, especially when it comes to identifying the entity. And when I teach this in my 5-week course, this is what I teach every business owner. What is the entity choice first? Because until we have that locked down and pat, we will be stuck in the I don't know, what can I do? You see an opportunity come up and you're like, I don't know what entity I should be to buy that property. Now you're going to be out the opportunity all because of an entity choice.
And that's
And
part of your proactive tax planning, right?
absolutely. So my proactive tax plans go through which entity choice makes financial sense and legal sense. Because most people just think like, oh, I'll just go create an S corp. And here's something scary. In the eyes of the government, a sale is considered to have occurred even if you never sold the property. And what I mean by this is that I've seen this mistake where real estate investors turn around and they gift, or they title, is a better word of putting it, they contribute the real estate into the S corporation. Now, the problem with this is that, let's say I want to get rid of the property, but I don't want to sell it yet. I'm just going to just take it out of my S corp. So we distribute the value of the property out. Well, guess what? Uncle Sam's going to come and knock in because he wants you to pay him capital gains tax for a distribution, for a sale that occurred, even though zero money was passed. And now you could be like one of my other clients one day that found themselves owing over $100,000 in taxes because they did not proactively plan first.
That's crazy. That's crazy.
Absolutely. So that's important, right? So we've got to separate ourselves, and then we got to create the entity. And then here's something else. Yay, us. We just created new entities. In fact, if you're going to be a landlord, for example, there are certain deductions that you're entitled to take versus if you create a management company that is managing all of your properties, and they have a different set of deductions that you're entitled to take. And so what I do in proactive tax planning is we look at all of the legal deductions that you are entitled to take as a realtor. And this is going to include, believe it or not, the changes through the CARES Act. For example, here's something really juicy for all of us who deal in real estate. Chuck, you and I both know that when it comes to real estate, we get this lovely deduction on our taxes that actually does not cost us a penny. Do you happen to know what that is?
Depreciation.
That's exactly it. I call this a fluff expense. It's in my book, The ABCs of Deductions. Depreciation works like this. We get to use depreciation for the asset. So houses are not expenses. They are, as we know, assets, and they accrue over time. Their value increases. Well, Uncle Sam says this. Hey, listen, Chuck, I know that you have bought a house and people are going to use your house and they're going to put holes in the wall and they're going to ruin the roof eventually. And, all kinds of fun stuff's going to happen inside this house. And I don't want you to pick up the burden of having to pay for all that 100%. So I'm going to allow you to create an expense, although we don't really call it that. We call it a deduction, which is kind of weird, but we call it the depreciation deduction. And this is key when it comes to real estate. This is going to be your number one sweet spot, is depreciation, because depreciation has effects of anywhere from 39 years, 27 and a half years if it's residential, from 7 years, 5 years, to 1 year, and then 180 days. So they work in different ways depending on what you call it. So with that, Uncle Sam says, you bought this house, you spent $200,000 over on it. I want you to depreciate the structure of the building over 27 and a half years if it's being used as a residential property. So I don't know what the math is. I play an accountant, even though I have a degree and I'm licensed and everything. So I'll use my 10 key. Hold on just a second. So this is how you know you're an accountant. So let's see here, 200,000 divided by 27.5 years equals $7,272 in depreciation, what I call fluff money. Now that's important. It doesn't sound like a lot. It doesn't sound sexy. But did you know that if you enter something called a cost segregation analysis, that you can actually pay experts that come in, typically they're like dudes like us that come in and they go, Chuck, I want to look at the wiring. I want to look at the paint job. I want to look at the walls. I want to look at the flooring. I want to look at the this, the that, all of that. And what they do is they optimize it so that you can accelerate the depreciation. So what I mean by that, instead of this house being $200,000 and only getting $7,200 in depreciation, we can bring in specialists that itemize it out, and you could realize a potential, high in the tens of thousands of dollars in depreciation deductions in the first year. So this is like really valuable stuff. We look at that and we say, okay, how do we shift? How do we create this so we can maximize that deduction for you? The next thing is, we have inside of the real estate, when we create management companies, this is highly important because inside the management company is where we're going to finally pay you to administer everything for taking care of the property. So I don't know if I'm going to cross a line here, Chuck, but I'm going to reveal a dirty little secret in this industry. And the dirty little secret goes like this. I bring in investors because they all need to work with me. All right. And I'm trying to everybody's buck really go a long ways. And so, we're going to pass out through this thing called distributions, right? The rent minus expenses equals my net profit. And I'm going to give that out on a monthly, quarterly, or an annual basis to my investors. So this gets kicked out. Well, inside of that management company, these expense line items, there should be an expense line item for the wages paid to the people to manage all the properties, or the people that have to go out and get the investors, or all the people that have to do the advertising or holding these summits, right? So inside of that, now it's all going to go back to theoretically the guy who's really in charge, right? Like let's say you and I are best friends, Chuck, and we do this together. We're going to line our pockets a little bit first. And what I mean by that is you and I are doing the sales, we're doing the marketing, we're getting the investors. And so the management company is going to pay us to do that, which eats into the net profit and then kicked out as distributions to the shareholders or to the partners, unless you have it specifically written in partnership agreements or the bylaws. Isn't that crazy?
Well, depends. There's a lot of work involved in doing all that stuff. But say more about the tax, how all that is taxed in different situations.
Oh yeah. So that's the thing, right? So like taxes are like, let's see, what would be a good analogy? Taxes are like a doctor. So, right. So like general practitioner, you come in and you're sick with rheumatitis and we can deduct. So the doctor says, well, I got to diagnose you. We got to figure out what kind of deductions we can give you and then how that impacts different organs. So let's say, for example, the doctor prescribes you a pill and let's say to treat your diabetes. But there's a whole bunch of side effects, like it creates depression, it creates, weight gain, it creates this or whatever, like a whole bunch of things, right? So that's kind of like taxes, same exact thing. If we tell you to go form a equation, it's going to create side effect. And some of these side effects are great, most of them are, and then you're going to have some side effects that are not. But let's talk about that, right? So when it comes to real estate and the government, you have income. And way I explain this is that in the United States specifically, we have actually 3-tier taxes at the individual level. So at the very big, we have this thing called ordinary income, which is all sources of income, legal and illegal. Al Capone wasn't put in jail because he murdered people. He was put in jail because of tax evasion. So legal and illegal all should be reported to the government. Underneath that sits another little umbrella, call that self-employment tax. This is going to come 1099, the independent contractor that is not a corporation. And then underneath that sits another teeny umbrella, and we call that passive income tax, capital gains tax primarily. So it's going to be taxed on of your earnings. If you are your passive income from real deals or S corporation income, tech passes through the capital gains area first, but doesn't really get capital gains until you start to sell the assets or shares or vice versa. And it bypasses the employment tax and it goes straight into your income tax, where it's going to be subject to a tax of 0 to 37.5%. Capital gains, on the other hand, depending on how long you own the property, will go from 0 to, I believe it's 15% to 20%, depending on the length of time you hold on. And it's also slightly affected by your ordinary income as well. So this is interesting. So if I form a partner, all right, in the eyes of Uncle Sam, this is equivalent to people who come together and get married. So this is really what's happening. They're coming together and they get married. And together they earn income. Now, if I did not have a partner, I would then be what we call a sole proprietor, subjected to self-employment tax, mandatory 15% above bones. Bring on a buddy of mine, we create a general partnership. Rules still apply. If it's a 50-50 split, then the income I take passes through on a scheduled K1, passes through to my per tax return, where the income is subjected to ordinary income tax and self-employment tax. I'm an active partner in the partnership. Now, the rules change. If a partner and I'm just passing a partner, as Chuck comes to me and says, I'm going to give you a great ROI on your money. It's only $50,000 to invest. I'm going to give $50,000, but guess what? I become a partner, yay me, but I'm not actively involved. I'm doing my thing, and him and his team are out there making it happen, babies. And as a result, Uncle Sam says that income, we call it passive income, passes through first the capital gains on a K1. It passes through the self-employment tax, not subjecting it to me. I'm not subjected to it. And then it pops out under ordinary income tax, subjected to ordinary income tax. So that's a huge difference, because we have to really put a lot of tests when we run these analyses. We have to determine, is the investor, are they active or are they passive? Now, a lot of people like to say, well, I'm active, because that's what everyone defaults to. But there are certain rules that the IRS puts in place that says you must meet, and right now I think it's 5 conditions. You must meet 5 conditions and a telephone ringing for you in order to be a passive, or better yet, an active investor. And this is important because of this. The reason why every real estate investor like you wants to chase the active position is because Uncle Sam has some rules, and he says the following. If you are an active moneymaker, business owner, real estate, etc., if you are active and you materially participate in said organization, then the income, assuming it meets all its tests, are active income. And that's important, because active losses offsets all of the income. So what do I mean by that? Well, let's say, for example, I, by my lonesome self, go and buy 5 pieces of property. And I put in the required time, 750 hours minimum per year. I keep logs. I have a separation of entities. I am doing all the administrative duties. I'm in charge of all the contract writing. I'm in charge of all the overseeing. I am acting as the head honcho, and I'm doing it all. And again, I'm meeting 750 hours minimum, and there's some other ones that I got to do. I do all that, and it so happens that I have a loss on the books of $100,000. That looks terrible. But let's just say, though, that my management company paid me $100,000 in W-2 wages. Well, because I'm actively involved in the business that lost $100,000, and my W-2 wages is also considered active income, by the way, is $100,000, then what happens is I have no taxable income. It zeroes out. Now, where this gets muddy is in the passive rules. So, same scenario, except I'm not working the 750 hours. I'm not really tracking my logbooks. I'm not really doing like all the things that I should be doing. As a result of that, what happens is Uncle Sam slaps a limiter. He puts the brakes on, and he calls this, are you ready? Passive losses. He suspends them. And he goes, guess what, peeps? Passive losses only offsets passive income. Now, that's not a bad thing if I am a passive investor and I'm making a shit ton in the passive world. But it's not a good thing if I don't have any passive income. I only have active income, and I only have passive losses. So they get suspended, and they first get, well, thanks to the CARES Act, on March 28th of 2020, the CARES Act was enacted that allows us to now go backwards 2 years. This is what I'm talking about is called a net operating loss that happens in business, both at the real estate level and even your active business level. So we're allowed to carry the losses back 2 years. You have to go back to the oldest year first, and then you apply the losses there. That frees up some money for you. And then we carry it to the next year, and then we carry it forward if it's not been extinguished. So that's the importance of passive losses and passive income versus the active losses and the active income. And through proactive tax planning, my friends, we help you to guide the landmines that are waiting for you, because all it takes is one little step to the left without guidance to lose the active income status. Did I help?
Yeah, you don't want to do that. You don't want to lose that. You don't want to lose that active income income earner status.
Absolutely. And again, if the goal is to be an active investor, then we have to do everything in our power to be an active investor. Now, here's something interesting too. So I actually answer this question a lot. Do I have to be a licensed real estate investor, right? Or a licensed realtor to get this active status? Well, my friends, I got some news for you. And the truth is that no, you do not need a real estate license to get the tax benefits like you would if you were a realtor already. Now, I'm not advocating and saying go buy houses without a license. I'm not advocating that at all. But what I'm saying is that if you meet the real estate rules, realtor rules for the IRS, then you are considered an active real estate investor. So, and I just realized that I think they call it a real estate professional. So that's the actual word that are used, is the real estate professional. And that's important because that means that I don't necessarily have to go become a realtor. I can just rely upon all the rules that I have to adhere to in order to get the same type of status and the same type of deductions that all my other realtors are basically kind of given as a result of them being a realtor. And again, the rules apply. You got to prove you're putting in 750 hours. You got to put in, make sure that all of your total services you're performing in the actual trade of the business itself. So, and that you're materially participating, that's super important. So there's all kinds of rules that relates to it. But if after we have a sit down and have a discussion about how active you are, then we can design a tax plan to make sure that you continue to stay active.
Well, let me ask you a question. You've got your 5-week program that you talked about earlier
Yes.
that helps business owners. Can you tell us a little bit about that so that they'd have an opportunity to begin to interact with you and your company?
Oh my gosh, yes. Let me tell you about this. So it's called More Money, Less Tax, the Blueprint. And what it is, it's a 5-week program that essentially covers all of the core basics that every business owner needs to be successful. You know, I mentioned earlier in the show that this being a successful multi-six-figure business owner on my own and hiring now over 15 different people doing 15 different things for me simultaneously was not always the case. You know, I wasn't always in the position to just buy myself brand new Priuses for myself and my husband last year. You know, I wasn't always in the position to just go out and buy me a house so I can live under. I wasn't always in this position. And it wasn't until I began to truly understand the foundations of taxation that it allowed me to make better business decisions inside of my business. And so what I discovered in that was this. The number one thing that I'm told by all tax clients, including my multi-7-figure company that started working with me back in 2017, on a napkin. They came to me on a napkin with no business, anything. They just came to me in a napkin. What I realized is that every single people like them asks these questions. How do I separate myself from my business? Well, I go over that in detail. What can you do? The actual techniques that you can actually put into place. Because I'm telling you guys all right now, the moment you start dealing with a whole bunch of entities, like one of my clients, she came in, I'll give you a story. She's a real estate client. She came in and she had 1, 2, 3. I think she had 4 rental properties, 3 of them in Georgia. Okay, that makes it 4, 5, 6, 7 rental properties. And she had just purchased a commercial building after we had just met. And then she had a management corporate company. She had no idea how to actually manage it. And she had a holding company. She didn't know how to actually use it. She had a finance company that self-financed, which, by the way, the CARES Act changed the rules for that, for self-interest rules, for interest deductions. It used to be 30% limitation. I think now they increased it to 50%. So my point about this is you've got some of these things, all these entities, all of these different rental properties all in place. Well, the separation of self is so important here because when she came into me, they were all under one house. They were all under one entity. All the management was doing on the same company. Everything was in the same house because that's how the lawyer told her to do it. Unless it was a tax attorney, I don't know how she got the advice from an attorney. I'm just saying. So I happen to be a tax expert in this. And so what we did is we unraveled it all for her and we created separate entities for her properties. We got the cost segregations in place. We managed to separate her corporation that was managing all this and separate it out. We got what I call advanced deductions, which I cover in my course, of how to actually hire her children and hire her family member to do a lot of the management for her, how to write off the corporate vehicles inside of the corporation properly, and so forth and so on. She went from owing the government $376,000 and some change in taxes. And at the year end, when she went to file the tax return, or I should say when we filed them for her, she only had to cut a bill. Her tax bill was $72,000. So what's it worth to us? You know what I mean? To go from owing over $300,000 to just $72,000. And it's all done legally through proactive tax planning. So it's understanding the deductions. It's understanding how to separate myself. It's understanding the entity choice. And then this thing called audit. So we can never avoid an audit in the United States at all because the government uses at least 7 different techniques for an audit. It's going to be just because at random, you were randomly selected. That's random. You were selected because you omitted something from your tax return that was reported to the IRS. You will be audited because maybe they want to do what they call a market research. They themselves are interested in knowing who is honest as a whole industry. They did this with lawyers. I want to say it was like in 14, around there. And what they discovered is that lawyers were extremely notorious for being dishonest about the income they made in their businesses. And as a result, now, when you work with a lawyer, you must issue them a 1099 if it's over 1 penny, which is very different. If you hire me and pay me over $600, you only have to report the 1099 after the first $600 has been issued. So there's a huge difference here, right? So it's research. Sometimes they want to know, for example, segments of populations. So they want to know, like, certain industries in different cities, things like this. For example, as a real estate investor, you guys should be looking at qualified fund opportunities, qualified opportunity zones. These are all places where the government created places for us as investors to go in and lift up impoverished areas and bring them up. So the government identifies it with the state government, and they say, as a result, we're going to issue you tax credits. And this is really important because tax credits is a reduction for dollar of your tax bill, unlike a deduction, which is a reduction of your income by a percentage. But tax credits are dollar for dollar. And or we also use something called deferment. So meaning, if you're super wealthy today and you're at the maximum of 37.5% today, what we can do is defer strategically future income to a later period. And we do that through something called a 1031 exchange. We've all heard that before. We all do this through qualified opportunity zones. We do this through captured insurance programs. We do it through different ways in which it defers the taxes to a later period. So in my course, I go separation, entity, advanced deductions, and then audit protection. Again, simple techniques that you and I, Chuck, can use today to keep us out of hot water, because should they come knocking on the door, you're going to have your ducks in a row, and you're going to be able to use someone like me, an IRS enrolled agent, to defend you. And at least we have all of the ammunition to fire back. Because Uncle Sam says this: I want you to make money. I want you to be successful, because here's why. His ass don't want to take care of you when you get older. It's as simple as that. So he wants you to take charge of your own destiny. Well, as long as you play with inside his rules in the sandbox, he's okay with it. It's the moment we start to break the rules that he's no longer okay with it. So this is the important thing too, right? So I go over all that, and then here's the beautiful thing. On the 5th week, I do an actual, to a lucky winner, a live tax planning session for everyone to witness that can come out to thousands and thousands of dollars in tax deductions, depending on the person who wins. And I normally, it's a value of over $24,000 already. I do that in the 5th week along with Q&As.
All right. So Jonathan, so how do people find out about your course, and how do they, that you have a free gift, I know, for people, how do they receive the free gift from having been with us today?
Yeah, let's talk about that, right? So so first of all, I wrote this book, The ABCs of Deductions, an Entrepreneur's Guide to Tax Write-Offs. And I wrote that because I realized that if every business owner like myself has at least the foundation that builds confidence, which means I now make better business decisions, which means I keep more of my money, which means I bring that money to my family and give my spouses the lifestyle that I too want. I get to send my children to private schools. I get to have the latest and the greatest. I get to have the best life I could ever imagine, while at the same time having cash in the bank. Because it's like my friend asked me one day, "What's it like to be you, Jonathan?" And I said, what's it like to be me is to never have to worry about how you're paying for things. And that is what I call the PFS effect after we're done with my 5-week course. It creates security, which leads to what I call financial happiness. So as a result, I write this book. So you're going to give this book away, and people are going to get it in their hands right now, today. And it's I'll read it out loud, and then it will be in the material. It's basically https bit.ly/free ABC book, all one word, free ABC book. What that's going to do is that it's going to send you to an area where you can get your book. And then from there, you're going to be invited to find out more about my 5-week program, More Money, Less Tax, the Blueprint. And again, there you'll also read about the scholarship that we're offering, up to $1,700 to women and LGBT business Q-owned businesses. And then we're launching it. It goes live October 15th. We are keeping it very intimate to a maximum of 15 participants. So those are just some things to consider, but that is what we're ultimately giving away as my book, which I know for a fact that even if you're in real estate and you're actively involved in real estate, you can begin to consider and think about the things that Uncle Sam wants you to consider when dealing with your business. And I'll end this particular segment thought with saying this. Please do not listen to me as advice. I forgot to say this in the beginning, but my lawyers get on me all the time. Whatever I'm saying right now, or you read in my book, is not legal advice. It's not tax advice. It is strictly something for you to acquire some knowledge and some information to begin the transformation of empowerment. But otherwise, when it comes down to the real advice, you're going to book an appointment with me and we'll follow up with you once you get my book. And then we'll have a chit chat one-on-one about the things that we can do to help you. And I call that my tax opportunity discovery session. It's free, it's 30 minutes, and it helps us to really zone in and narrow in on what your needs are as it relates to yourself, your business, and ultimately your real estate dealings.
All right, Jonathan, thank you very much. We appreciate you being here to share your, knowledge. I've been in the real estate business for 50 years, and there's things that you've said that, I never have given much consideration to. So I really appreciate it personally, but everybody should be reaching out for your book and to get in touch with you and talk to you about your 5-week program. So
absolutely.
Thanks for
yes.
being. All right. So in the next segment coming up, we have Mike Wolf. Mike Wolf is a multifamily housing investor and expert, and he's going to come. He's going to have an extended session of just under 2 hours, and he's going to come at the top of this next coming hour and talk to us about that. And one of the things he's going to include is what are the ways to make money in real estate, even if you have little or no money. So he's going to share a little bit about that as well. So we look forward to seeing you in that next hour, and we will see you then.